In this chapter, we're going to learn about money market. The money market is an institutional arrangement where we deal with short-term funds. So here short-term funds is the highlight because in money market we deal with short-term instruments. Now RBI is the regulating body for money market. So it will be apt to learn RBI's definition on money market. Money market is defined as the center for dealing mainly of short-term character in monetary assets. It meets the short-term requirements of borrowers and provides liquidity or cash the lenders. This is the definition by RBI. Where you see there is short-term character for these monetary assets and it meets the requirements of borrowers, short-term requirements of borrowers. It provides liquidity or cash the lenders because here it is short-term assets or short-term instruments which have more liquidity and it provides cash to the lenders or cashes the lenders. Not cash as such, it helps them, it cash the lenders. So that is money market. The features of money market would give us an overview of what money market is, a more better idea of what money market is. It is a market for short-term funds or financial assets called near money. So since it's for short term, it is called as near money. 1. 2. It deals with financial assets having a maturity period of 1 year. So we saw it's a short-term fund and the maximum maturity of those are 1 year. The third one is borrowers will get fund for period waiting from a day, a week, a month, 3 to 6 months. So it could be of different periods. The maximum is 1 year, but it could be anything less than 1 year. And the maximum is 1 year. It could be a day, overnight also, a week, a month, whatever it is, 3 months, 6 months, different ranges. But the only thing is that maximum is 1 year. Fourth one, it is a collection of market for following instruments. You have many money market instruments like call money, notice money, repos, term money, treasury bills, commercial bills, certificate of deposits, commercial papers, interbank participation certificates, intercorporate deposit swaps, bills of exchange, treasury bills, etc. And we'll be learning some in very detail. So these are the money market instruments. The next is money market consists of several sub-markets like call money market. These are sub-markets of the broad money market, trade bills market, okay? And these sub-markets are interrelated. They have close interrelationship and there's free movement of funds from one sub-market to another. So free movement of funds is there and they're closely related. Next one, the borrowers in money market are traders, manufacturers, speculators, and even government institutions. So there are various borrowers in money market. It does not refer a particular place where borrowers and lenders meet each other. That means there is no such physical place. It is a virtual place you can see, okay, which is regulated by RBI. A lot of instruments. Okay, there are very participants like banks are all participants of this, but that is not an actual marketplace, right? Next, transactions can be carried through oral or telephonic communications. So that is how transactions take place. There's no such physical place. The relevant documents and written communication can be exchanged subsequently. So you can subsequently exchange these. You can have oral or telephonic communications and you don't need to actually have a physical place. All right. The important components of money markets are central bank, commercial banks, NBFCs, non-banking financial institutions, discount houses and acceptance houses. Discount houses and acceptance houses, like places where we discount the bills. All right, we learned about how we discount bills. Okay, financial institutions, they help you to discount your bills receivables. So that is discount houses and acceptance houses. The next is, does not deal in money but in short-term financial instruments or near money assets. So that is not actually cash. It is not money. It is actually instruments or near money assets, short-term instruments. But since it's very for short periods, it is like near money. It is a need-based market wherein the demand and supply of money shape the market. So here there are various factors, demand and supply factors, which actually play as the most important forces and which shape the market. Okay. Next, we'll see the objectives of money market. First is overcome short-term deficits, right? It helps you if an institution have short-term deficits, they can actually, overcome it. They can actually get the amount required with the help of money market. And with those who have surplus funds, they can actually deposit or park it into such instruments. Those who require money can also acquire it. So that is the first two objectives. This third one is to facilitate the central bank to influence and control liquidity in the financial system. So you have heard about monetary policies, right? So such to ensure that or to control liquidity in the market, money market is very important. So you have heard about repos, how repos are used for monetary policies, bank rates, how do they control interest rates. All these are done by central bank with the help of money market instruments. Fourth, to provide a practical access to consumers of short-term funds to meet their requirements rapidly, sufficiently, and at rational cost. So you need to get all this done. You need to overcome short-term deficits. You need to park your surplus funds. You need to control the economy. Everything should happen rapidly. It should be sufficiently effective at rational cost, at maximum lower cost. So for all this, money market is required in the economy. Okay. Next, we're going to see the features of a developed money market. So you can see how a developed money market will be. The first is it will have a well organized banking system. All right, banking system well organized. Banks, commercial banks. Commercial banks are one of the major participants of money market. Okay, they are the major suppliers of short-term funds. Now, the policies adopted by commercial banks therefore have an impact on the money market. And even quasi-government bodies and large companies supply funds in money market through these banks. Okay. So an existence of a well-developed and organized commercial banking system is very important for a developed money market. So first is banks. All right. How developed they are first. Second is existence of a central bank. Central bank is the banker's bank. It is the monetary authority of the country. All such things. They issue currencies. They control, regulate, and supervise these commercial banks, which we earlier stated. So they are the regulating body. Okay. So a strong central bank for a country is very important because they are the people who regulate the money market. They're the people who have to regulate banks and other institutions or money market as a whole. So you need to have a strong, or you need to have a proper existence of a central bank. Third is availability of proper credit instruments. There should be readily acceptable negotiable securities. Negotiable means transferable. There should be negotiable securities like bills of exchange, treasury bills, commercial bills, okay, government bonds, short-term government bonds. So there should be a number of instruments also, and there should be a number of dealers who will deal with these instruments. So money market instruments are also very important components because they are the actual, the essence or the most core of the money market. So there should be proper credit instruments also. Next is proper coordination of different sectors. There can be different sectors like organized sector, unorganized sectors. So it is actually difficult to control these unorganized sectors. Therefore, the RBI is trying to bring everything under its control. But there are unorganized sectors, so there should be a coordination between these sectors for for a developed money market. Next is lack of diversity in money rates of interest. That is, you will see always that there is a uniform rate in our country for interest. There's a uniform rate of interest in our country. So it should be more or less uniform. All right. The rate should be uniform. It should not, vary according to institutions. There could be a minute changes, but that is within a particular range. It's just a small change. All right. But almost it is all uniform. So there should not be a major diversity in the money rates of interest. Okay, especially for financial institutions. When you see they have only a rates within a particular range. All right, and most of the rates which are taken by RBI is also uniform. It is applicable to everyone. Presence of bills market. Bill market seems to be absent in developing countries, or basically less developed countries. Okay, the bill market. You have trade bills, bills of exchange. So such market seems to be absent in less or underdeveloped countries, or in basically underdeveloped money markets. All right. Next is sufficient resources. Funds are required to finance the transactions in submarkets. You need sufficient funds. You need sufficient funds from various sources, internal, external. So you need to attract it from different parts of the world if you don't have sufficient funds. All right. So sufficient resources, sufficient funds is important for a developed money market. Next is existence of secondary market. In secondary market, we deal with derivatives, which we told earlier. I told you, right? Like if it's an interest rate we're dealing with, here we trade with the changes in the rates of interest. All right, we're not actually dealing with the interest rate. We're not actually depositing our money or lending our money and getting an interest. We're actually trading in the changes in the interest rates. So that is derivatives. So secondary market mainly deals with derivatives, and these derivatives require money market instruments. So if the money market is strong, only then the secondary market can also function properly. So existence of secondary market is very related with the money market. Next is ample supply of funds. That is, as we told earlier, there should be sufficient resources. There should be sufficient funds, because there is a high demand for short-term funds, right? The fund amount will be large. Only thing is that you require it for a short period. So, it is actually related. You need a lot of funds. As we told, we need sufficient resources. We need ample funds for a developed money market. All right, and other factors are also there, like expansion of international trade. For that, you need money market. Industrial development, all this are features. You will have international trade, a good international trade or international trade can be expanded. There will be a good industrial development. There will be stability in political conditions, and in a whole, your economy will be doing well if you have a proper money market or a developed money market. And these are the features of a developed money market.